when we actually draw the volume profile from the high to the low. So we can see, obviously, the volume range we were looking at got quite high block of orders. This area too has quite a high block of orders compared to the rest. So this is a sort of a, an area where we could expect a lot of liquidity. And obviously, does this correspond to our technical sort of chart analysis? Well, yeah, because this level corresponds to that 4-hour internal liquidity range high getting swept. So we can sort of confirm this is a key level. There isn't much more volume which exists unless price was to come and take this high. Price is unlikely to want to come here because there's little volume. It's likely just to liquidate this area and continue down. So obviously from my bias, my bias is to see sells within this range. So I'm not expecting the price to come take this high up here. So the next logical place, if price isn't trying to play off this level here, is to play off here, the next largest sort of block of orders, which price does. From there, we see our liquidation of the Asia range high, as we discussed at the start of the call. Have an algo candle. We're going to talk about this later, well, very soon actually. And then from there, we get our confluences on lower time frame, which we'll discuss in depth later on. However, my sell position today was here. Off of this level here. TP1 at a potential area, which price may want to sort of retrace from. You've got to think every significant liquidity point in the market is a potential area the market wants to sort of expand or continue from, pull back or an expansion. So TP1 at these sort of sensitive liquidity areas in case price is interested to sort of come into this range and clear this liquidity and give a reaction. I also stacked another sell inside of here too, and I also then stacked another one lower down, but I'm not going to talk about entries too much currently. We're going to talk about them later. But yeah, I just wanted to cover like the sort of fixed range volume stuff. It's quite a good tool to use. So let's get talking about support and resistance liquidity. So I'm sure everyone's aware of how retail predominantly trade using support and resistance theory. We can use this to our advantage in trading, viewing it as sort of liquidity and using it to justify the strength of levels and giving us trade opportunities to play off of the liquidations of them. Let's hop onto the chart and just take a look at some examples. It's a lot easier to view than talk about. So in this sort of current market condition here, we have this buy to sell range in price, and when you drop lower onto the lower time frame, you can see we have these internal equal high liquidity points, sort of internal range liquidity by this OB range. Price forms this AMD model, so essentially the market maker model, and accumulation, manipulation, and the distribution of orders. So in terms of the liquidity cycle, the market builds liquidity on both sides. It will liquidate one and attack the other. So this is essentially the 5M liquidity cycle, where the market has built liquidity on the 5M on both sides of the market. It then will liquidate 5M liquidity, and then it give a 5M expansion down to clear the rest of the liquidity. So this here is one cycle in the liquidity cycle, and obviously the liquidity cycle is a fractal concept of the market. So essentially this 5M liquidity cycle here will all play inside of, say, a 15M or 1 hour higher time frame liquidity cycle, where we've had our higher time frame draw on liquidity. We come here, we reject, we begin to sell off to attack more liquidity. And then, once the 1 hour liquidity cycle is complete, this liquidity has all been cleared. The next liquidity cycle will commence, which could be potentially, once liquidity has been cleared, we come to clear, say, more liquidity, continue down, etc. This is sort of how the liquidity cycle works. It's like a magnet between liquidity to liquidity. And it all falls sort of in place. So the 5M liquidity cycle will act with the 15M, the 1 hour, 4 hour in mind. So it moves within each other. It's just a fractal way of the market moving. So sort of on the way to target a 1 hour liquidity point, you'll drop to the 5M, and within this 1 hour push to run liquidity, there will be 5M liquidity cycles, and then also 1M liquidity cycles too. So when we look at this OB range with internal liquidity, we've had this AMD. We understand that price is built liquidity, so it's liquidated one. So once we expect price to reach a sort of key level to play off of, we could expect sells to come and target this liquidity. We can also see that price has left behind a nice smart money trap. And going back to the smart money traps, why is it a trap? It's large volume and it has no inducement. Got that nice big vector candle push up into this POI. Why is this a sort of interesting thing? Well, what we know about vector candles is an aggressive mitigation of the zone. We usually give an aggressive reaction. So this aggressive push in will usually give an aggressive push out. It's essentially a fake demand in the market. It's fake buyers, fake buying momentum in the market, getting, the RSI, the volume, the sort of RSI indicators, the strength indicator traders who operate around sort of volume of buys and sells, getting involved on these buys after such a large, heavy movement. It's essentially just fake demand in the market. And yeah, going back to the main sort of concept in question is support and resistance. So why is this a sort of key POI? Well, we can clearly see that we've had this support level here, which is this low, all of these lows here, and we flip and turn into slight resistance on a lower time frame in here. So this is a key support or resistance level. So we know there's a lot of liquidity exists here, and retail traders may be inclined to be taking sells off of this point. And this aligns perfectly with our order block range and our lower time frame 5M liquidity inside of here. Price can liquidate this support resistance, mitigate this range to then continue bearish. When you follow it through, you can see this has had quite a few sort of. This is an interesting psychological level for the retail traders. Price is happy to come liquidate and mitigate our OB range. There we go, getting that final liquidation in there. Very nice. And coming down, mitigates the smart money trap, but fails to hold since it never breaks this high. So it never gives a clear break structure. So this SMT essentially fails. So there could be a perfect sell opportunity up here. This is a great sell because the setup is still valid. One, because the liquidity target, which is this AMD on the 5M liquidity cycle, these low, these equal lows of liquidity. And two, the smart money trap never got violated. So since we are expecting this level to fail, since it didn't fail, we're not expecting this smart money trap to hold, which means we're not expecting it to take the high. So if we're expecting it to not hold, we're expecting it to go, the market to continue and fail this level before it takes out this high. So somewhere within this low and this high, it's going to push up and then come down because we anticipate this low to fail. Hence why this sell position here is valid. Also could get involved on lower time frame confirmation with a sweep of liquidity. This is still valid. Why? Because we still generated liquidity. You know, you want to be getting in the trade when the liquidity is still generated. You don't want to be getting involved after we've started to sell here. After we've started to sell down and this liquidity is starting to be cleared, don't want to be getting involved. We want to be getting involved with anticipation of the liquidity to be taken out. Market beautiful trade. Would have a bigger stop loss too. Would be beautiful. Sort of a way you can use support and resistance in a trade example. Let's get forward price a bit, since it looks like I've got some support and resistance marked up in there. Cool. So, same goes for this POI here. We have this order block range. It has valid liquidity. You may argue this inducement is not immediate. It's not exactly extremely close to the level. However, we have support and resistance for this inducement. So this makes this a very strong high, a very strong liquidity point, sorry, especially since it's a very reactive candle. So these high momentum candles will store more liquidity. So this is a high momentum candle. It's also acting as part of support and resistance liquidity, you know, and causing a fake breaker structure. So we've called this fake bars down. And if you can remember when we talked about algorithmic structure earlier on in the video, this breaker structure can be seen as fake for price to liquidate. So these highs and lows don't have to hold. Price isn't going to form these perfect high lows, high lows. And people who trade structure then see this shift. They'll see this shift like this and be like, that's a change of character in the market, expecting the market to be now shifting bullish from bearish. However, this is simply just a repricing model by the algorithm. Take out liquidity and to continue down. As you can see, you know, part of the liquidity cycle, the algorithm will build liquidity. You can see it's built liquidity, and it will take liquidity. So it takes liquidity, reprices to a well-priced level, this OB range, and then sells off to target this liquidity that exists here. We've also got this higher time frame, support and resistance. Hold on to the 15, and we can see, get rid of this. All these consecutive highs, we have 1, 2, 3, 4, 5, 6, 7, 8. Why is this still valid in here? If you have a look, these candles here, the body holds the support and resistance, the wicks never break. So this is a very strong support and resistance level. There we go. Price hits us with that vector candle, as we've discussed. Came across quite a few times. What does it do? It's the same AMD model. Price builds up this range. You know, it's all part of the liquidity cycle. We build liquidity on both sides of the market. One side gets liquidated, we continue to the next. We mitigate a well-priced level, and we continue down to target the next liquidity. So we know under all of here, we have lots and lots of liquidity. We've perfectly engineered this. We liquidate, we mitigate into a well-priced area, and then we come back down to liquidate the other side of the market. We liquidate these perfect support and resistance liquidity points. We leave behind smart money trap demand zones. So these demand zones, which on the way down, smart money traders may see this very strong momentum with a break of structure. They may be interested in taking a buy from this level, essentially may fail. well, will fail since it's a smart money trap. This is our liquidity cycle completion level where we expect price to deliver to. Perfect. You can see this candle showing resistance from this level. Traders getting involved into buys on the 1M and then failing. We deliver to the liquidity point, which is our target, and then our high time frame liquidity point, which could be this next low, and potentially even this low, and potentially this set of equal lows. And this set of equal lows is all a part of a high time frame liquidity cycle where we build liquidity, we come and liquidate, we build liquidity, we liquidate, we take out liquidity, we have a money transfer, and we come to liquidate. This is the liquidity cycle, guys. The market build liquidity on both sides of the market. We build liquidity, we liquidate one side here, and we trade to the next. Happens through every single time frame. There we go. So then price delivers to the liquidity point, and then also by the looks of it, even a higher time frame liquidity. Now we've delivered to higher time frame liquidity. The market will probably reverse in due time. So we've delivered to higher time frame liquidity. So now we need to attack the next part of the liquidity cycle. So looking at structure, turn this Asia range off, it's kind of annoying me. If you look at the algo structure, we have a low, a high, a low. This is the algo structure high, which gets liquidated. We have our build-up of liquidity. We have this fake move down. We're anticipating this high to go. We build equal highs. This push here is fake. Fake momentum for the market to get sellers involved. Getting people involved in these sells to buy up, to liquidate. The people selling here to also liquidate the equal highs here, and then also liquidate this high time frame level. And we know we've took a lot of liquidity here. So we know we're going to get a big move. So because of all this engineering liquidity, we was able to take out this 4-hour and daily set of equal highs. So, you know, we've had a very large play on liquidity. So now we're coming to attack the next liquidity cycle, which is going to be more liquidity when we take a look at the algorithmic structure. High, low, low, high, low, bang. So we've got this, what? A low, a high, low, a high, low. Getting liquidated. Structure being disobeyed. Likely we'll see sells from above this liquidity high. You can obviously look deeper into price and be like, what have we actually hit? So obviously we've cleared the liquidity necessary, and we have filled this imbalance which exists in the market. Might as well touch an imbalance whilst we're here a tiny bit. This is an imbalance because this low, this high never mitigate each other. We have this gap in the market, this big hole in the market, which is a magnetized area for price to come to. So taking liquidity and filling imbalance, all are part of the liquidity cycle to come and target the next point of liquidity. Generating liquidity for the future above these highs. There we go, the market continues down to liquidate. These highs will become a future liquidity point somewhere along the line. All of these highs will become a significant liquidity point somewhere along the line. And the liquidity cycle continues. Building more liquidity, taking out more liquidity, etc. So I'm glad we've touched on that now. I'm going to move on to the next part of liquidity, talking about fake structure. So the biggest thing to note is that price does not require structure to move. Essentially, using the trend or the direction, the formation of highs and lows to determine the direction of the market isn't necessarily the best way to trade it, simply because structure naturally exists through price movement. For the algorithm to move price, it cannot just pump the market straight and then just reverse. Internally, in movements, you're going to have highs and then lows and highs and lows and pullbacks and then expansions and more pullbacks and then expansions. Why is this a thing? We've already covered it slightly, but for the market to generate liquidity, both buyers and sellers need to be satisfied to take trades. So when we have an aggressive push up, a nice bullish leg, we will get a retracement. What is the purpose of this retracement? Well, to get more buyers involved at a more fair price. They see price retrace, they're more inclined to take buys, and also to get sellers involved when they see the market start to reverse and start to go down. So both sellers are happy to get involved here, and also both buyers are happy to get involved too. So price will naturally move like this to generate liquidity, and this is why there is significant liquidity above every structural high and low. And that's why algo structural movement occurs, because above and below each high is significant liquidity. That's why we can take trades off of this structural liquidations. So the algorithm uses liquidity to move rather than structure. So when you may see a structure shift like this. It may not be a change of character in the market. It could just be a liquidation to continue going. So we don't pay attention to structure. However, we pay attention to liquidity to move the market. One sort of main way liquidity can be generated is using structure. So, for example, prior to sort of a mitigation of a level we're sort of interested in. So, for example, this POI here on Euro USD, this order block has nice inducement, as we discussed earlier. Very, very clean inducement. We could be looking to take buys from this level. We've got this whole trend being liquidated here. This level gets liquidated. Price starts to sell off. So when we have a look down on the lower time frame, we can see that price is now gave a change of character, a shift in structure, where we've had a break higher, had a pause to the upside. So when you mark out swing structure, we've now had this pause. This pause leaves behind this demand zone. However, we would identify this as a fake shock or a fake break of structure, since we are looking to sell this level. So this is a very strong confirm. So if we are looking to trade a certain level and we see a fake break structure, we know that this trader is looking to get involved into buys of this level. So as price can approach our POI, there you go, you can see traders getting involved in the buys here. Then we've got, the lower time frame, traders getting involved off of S&Ds, mini sort of demand zones inside of here, looking to take price higher. And then price liquidates. So seeing this pattern occur before our POI is a strong confluence, since we've now witnessed structure traders seeing this as a shift in market structure, looking to take buys, and you can see them getting liquidated here. Also, in this particular example, it's also built up quite a lot of liquidity, resting for the market to leave behind to come collect. Let me get a move away. The market starts pushing up from this level. All right. So in this sort of example here, you can see price has sold off at a particular liquidity point. This may just look like a wick on the higher time frame, but however, you can tell that on the lower time frame, there's going to be inducement for this high. As you can see, we have nice liquidity and inducement inside of here. When we have a look at this POI, before price comes to mitigate, just replay that. We see price begin to sell off early in the morning. We have this fake break of structure down. So the daily sort of the market is opened with a break of structure downwards, sort of looking to sort of contradict this trend here. Potentially getting SMC traders involved into sells in London session at these levels. However, this is a fake break of structure. Another way to tell by this example is that Frankfurt high liquidity too. And a little gem, which I think I dropped earlier, is when Frankfurt high sweeps Asia high, it's usually going to get swept again. So you see Frankfurt pushes above Asia. However, Frankfurt will usually get swept again. So if the Frankfurt range takes out the Asia range, we can expect it to likely get one more push, especially in this example when it's paired with this liquidity level, or if you use the market, this S&D supply POI with inducement, which we're looking at. And from higher time frame structure, you could argue that structure is still bullish, still making highs and lows and structural sort of movements. SMC would argue that structure is still bullish until this low goes here, since this is the last structural low put in, and this low broke structure above this high. However, us algo traders, we can find ourselves best positioned in the market before the break structure actually occurs. So we're essentially anticipating this trend to break, not because we understand liquidity. We understand liquidity existing. We understand the run on this fake breaker structure paired with this higher time frame level and Frankfurt high liquidity, anticipating this level to get broken. And then from there, the market continues to sell off. And so on until we get a breaker structure downwards. So when we actually draw this up into a sort of little diagram, so something to pay attention to. We have a fake break before the mitigation of the POI. Builds up liquidity, essentially leaves behind a trap. And you could find yourself involved with lower time frame confirmation with the entry models we're going to discuss later on in the video.